yelling? Give me the fucking money. Get the goddamn money printer out. Get the goddamn money printer out. Gonna be so goddamn rich.
I think it's time to blow this thing. Get everybody in the stuff together. Okay, 3, 2, 1, let's go.
Gonna be fucking rich. I want my fucking money. Griffin, I want my fucking money. Yo, motherfucker. Holy shit, we're gonna be so fucking rich. Damn it, we're gonna be so fucking rich. Griffin, I want my fucking money.
You're an original,
Hey,
aren't you?
yelling? Give me the fucking money. Get the goddamn money printer out.
Bounty letter.
We're gonna be so fucking rich. Get the goddamn money printer out.
Hello, everybody. Welcome to Boss Blunt's Think Tank. I'm Boss Blunts, the Butcher of Wall Street. Today is another video, which is the next in a series, looking at the financial, macro, and geopolitical implications of over-leveraging by banks, the Federal Reserve, and the United States, and the cause and effect that their poor choice of actions and sanctions have had on our global economy and the way that it will impact us as a country and as a world. Sadly, the news that I present to you tonight is probably pretty depressing for most, but unfortunately, although I'm an optimist, I am also a realist. And that being said, we've got quite a bit of news to share with you, including the fact that the DTCC is pretty much broke. I've got here a brand new filing on the Federal Register here. That's supposed to hit hits the Federal Register tomorrow, July 26th, and is available online at federalregister.gov. And we'll take a look at it now and then delve deeper into earnings, housing, jobs, and a lot of other things that are probably going to surprise you. Take a look at this. Cheers, everybody. All you 20,000 plus beautiful geniuses that have taken the red pill and have chosen to believe more than just what the mainstream media has told you, welcome and thank you for being here with us today. What we have here is the Options Clearing Corporation notice of filing of advance notice related to a master repurchase agreement as part of the OCC's overall liquidity plan. Big shout out to our guys here in the think tank that have just posted this up. Really appreciate that here. If you look here, we could see that the OCC is discussing obligations, and the description of the proposed change states that to meet such payment obligations, the OCC maintains access to cash from a variety of sources, including requirements for members to pledge cash collateral to OCC. For those of you that are unaware, this means companies that trade on the stock market and broker dealers and such, prime brokers, they have to pledge cash collateral to the OCC in order to be able to trade and to get margin and so on. I continue. There are various agreements with banks and other counterparties, liquidity facilities they're called, to provide OCC with cash in exchange for collateral such as U.S. government securities. This sounds very similar to the overnight RRP. Grandpa Barney, thank you very much, my friend. You are too kind. The think tank and I appreciate your support, truly. Thank you. The OCC routinely considers potential market stress scenarios that could affect such payment obligations. We'll take a side note here and think of things that would affect these obligations. For example, a crash in the equities markets, bonds, stocks, housing, other commodities, tangible goods, and so on. That remains to be unseen. Based on such considerations, the OCC now believes that it should seek to expand its liquidity facility to increase the OCC's access to cash to manage a member default. Quite simply, they're proposing to expand liquidity facilities to include a new arrangement with a bank to provide cash to OCC. These guys are absolutely desperate. There's absolute desperation going on here in the OCC markets. So this advance notice concerns a change to their operations to execute a master repurchase agreement with a bank counterparty as part of their overall liquidity plan. And they're going to exchange cash for U.S. government securities deposited by clearing members in respect to the clearing fund requirement to meet OCC's settlement obligations. It sounds like they're going to allow these counterparties to use their overnight reverse repurchase program treasuries here on their to as collateral as well. This further accentuates the issues that are being seen on the derivatives, the toxic derivatives, in hundreds of trillions of dollars by these banks. Let's get forward here a little bit, and we'll come back to this. We've got to seriously consider what's going on here with the OCC. Now, for most people, talking socially is how they think in a quite literal fashion. And metaphorically, I think that's true for almost everyone. And there are certain people who are actually like academically trained or have taken the time to learn how to properly think instead of just have thoughts appear in your head. You kind of have to divide yourself into these subpersonalities and come up with these well elucidated and differing opinions, and then kind of try to let those different personalities or elements of your personality have an internal dialogue, much in the way that many people discuss things publicly with others, in order to draw conclusions from that. And I think it's a very difficult thing to do, and a lot of people radically overestimate the ability at which they can do this. So to think critically, I believe to be one of the most difficult things for most people to actually grasp. most people just feel that thoughts appear in their head and that this is something that they've thought up. These are more just believing than actual coming to conclusions. Anyways, let's move on. Take a look at these earnings. This could be the busiest and one of the most important weeks coming up ahead of the entire summer. The Federal Reserve is expected to deliver another 75 basis point rate hike. Second quarter GDP and other reports are going to provide further clues that the economy is heading for a recession. Meanwhile, the United States Treasury and the President of the United States and the Democratic Party are all trying to pretend like it's not actually going to happen. Earnings are expected this week from Apple, Microsoft, ExxonMobil, Alphabet, and many others. Some of the biggest names. I think it's the attitude of investors will be what, if earnings season is a good thing or a bad thing here. But between Microsoft and Apple, and then Google's parent company Alphabet releasing results on Tuesday and Amazon on Thursday, as well as Meta Platforms, formerly known as Facebook, reporting on Wednesday, we have more than 1/3 of all S&P 500 companies reporting this week. Top of that, we've got several economic reports, which should add fuel to the fire on whether the economy is heading towards or is already in a recession. Yeah, there's 175 S&P 500 companies reporting earnings this week. And second quarter GDP is expected on Thursday, as well as on Wednesday, we're going to see a FOMC meeting and meeting minutes potentially. Personal consumption expenditures, PCE, inflation data comes out Friday, as does the employment cost index. Home prices and new home sales are going to be coming out on Tuesday, and consumer sentiment is going to be coming out on Friday. Speaking of consumer sentiment, if you take a look at the Federal Reserve data we have here, you can see pretty clearly that consumer loans, such as credit cards and revolving debt, are absolutely skyrocketing, over going towards $7 trillion. And then you can see also personal savings are at a level that we haven't seen since, 2018, really. So personal savings for Americans are at the lowest level we've seen in, this decade. And consumer credit cards, revolving loans are at nearly all-time highs. Well, I'm sorry, I was wrong. They're at all-time highs. Eric Vizcarra, thanks for your support. And DTC is not necessarily wasting money to save hedges. Okay, this is not happening. They're not creating this new proposal to accept a liquidity facility, like a reverse repurchase program acceptance facility, if it wasn't for absolute desperation, sheer desperation. And J-Bridge as well. We're going to be so fucking rich. Yeah, man. If you're properly hedged, I do believe that many people will get filthy fucking rich. And I'm not a financial advisor. None of this is financial advice. I'm just looking at data that I believe to be important. You should look it up on your own if it is of interest to you. Even the CEOs and the Philadelphia Fed are getting bearish on these things. Check it out. Pessimism about future activity grows amongst factories in the Philadelphia Fed region. This is the worst reading since 1979, a decrease of 18.6% in the level of current business activity for manufacturing by the Philadelphia Fed. That includes pretty much the entire northeastern United States. It's a very big swath of people and land. Millions and millions of people, tens of millions, if not hundreds of millions of people in the Northeast. Look at the factory work week. Gasoline consumption is down on high pressure, just as the United States summer driving season is in full swing. And the total implied demand for gasoline has not been this low since 2003. CEO confidence is at decade lows at this point. All right, guys. And you have to include, on top of that, yield curve inversions, the fact that consumers are at the breaking point. Their consumer loans are at all-time highs, and their personal savings are at lows not seen before in a decade, practically. Manufacturing outlook is the worst reading, we've had since the 2020 COVID shutdown, and before that, the worst it's been since 2010. But the difference was that the Fed was quantitative easing and printing trillions and trillions of dollars in 2010 all the way through just a few months ago. Corporate margins are being squeezed. The real money supply has decreased in the last 3 months average. Consumer expectations have plummeted over the last 3 months. The number of new building permits is down around 10% over the last 3 months. 3-month CapEx orders also down 5 to 10%. Nearly. Stock prices down around 11 to 12% over the last 3 months. The yield curve is inverted. This is weekly, ending every Tuesday from 2021 through today. This is the difference between the 2-year and the 10-year. The difference being negative means that the 2-year yield is higher than the 10-year. So no one's going to buy a 10-year treasury loan. No one's going to buy a 10-year treasury bond if they can buy a 2-year and get a better return on it. Or even better, if they could buy an overnight one via the Federal Reserve's RRP, Reverse Repurchase Program, and get a 1.55% return. Such as today, for example, July 25th, there was 100 counterparties from this very same liquidity that participated in the overnight RRP with the Federal Reserve. And those very same counterparties are the ones that are going to fund these liquidity facilities to the OCC with cash in exchange for these U.S. government securities. There's a massive desperation for collateral on heavily shorted stocks, precious metals, and commodities. That's why you saw London Metals Exchange have to reverse trades on zinc, for example. Was it zinc? Nickel, from $50,000 a ton all the way up to $100,000 a ton, and robbed over $6 billion worth of gains back from those investors and reversed those trades. Now, London Metals Exchange is basically almost in full shutdown. They have stopped the trading of silver futures because there's no demand. And it's something that's going to continue with LME. But let's not get into that in more depth just now. Let's continue on with the economy and everything that's going on here in the stock market. Industrial Production Index, the 3-month average growth is just barcoding up and down. Real sales, 3-month average growth is around -2, -3% nearly. Real monthly GDP is in negative territory for the second month in a row. And as all of you have seen, the Federal Reserve, the Treasury, as well as our other government bodies are trying to make you guys believe, make me believe that a recession is not real by changing, that this is not a real recession by changing the definition of recession. And it's so bad that the stock market is now pricing in 2023 rate cuts. They already started pricing in 75 basis points of rate cuts in the first quarter of 2023, ladies and gentlemen. Take a look at Bank of America. So this chart says, where's Lehman? I like that. That's a good one. This one's from Christopher Barad. Good looking out, Christopher. Net percentage taking higher than normal risk levels. There is a very intense risk-off situation going right now. According to Bank of America, levels that we've not seen since 2009. And I believe a lot of this has to do with the fact that BlackRock, for example, has lost $1.7 trillion so far this year, and the majority of that is pensioners, 401ks, and IRAs. That being said, investors are cutting equity allocations to the lowest level since Lehman because the stock market is not going to do well. The stock market doesn't always follow the economy, but eventually it catches up. The first half of 2022 here represented the weakest 6-month period for the United States IPOs since 2016 and 2017. Initial public offerings are down to levels not seen since the fourth quarter of 2016. My little one's trying to get in. But anyways, look at the number of transactions absolutely plummeting, almost to absolute zero. The gross proceeds in millions is almost at zero as well. I can't even tell you how low it is because it's closer to the zero than it is to the first number up here. Euro area confidence hits the weakest ever on inflation and recession risks. This is the European Commission's confidence indicator. It's lower than ever. What do you guys think the Friday report on consumer confidence in the United States is going to look like? It's going to look a lot like this, if not worse. Check out the United Kingdom. United Kingdom consumer confidence is at a 48-year low. Absolute destruction, absolute destruction of the middle class, of the poor class. Anybody who's not in the top 1% is feeling this extremely hard right now. This is a survey by Bloomberg, and you can see here during COVID, people were feeling pretty shitty about what's to come, and with the quantitative easing and all the printing of money and the low interest rates and the dumping of rates by the Fed, that spurred up a fake rally, a very long fake bull rally. And now the hyperinflation of everything that's occurred since the 1970s and even before that, the 1940s, when we separated the dollar from the gold standard, is finally catching up to us. It caught up to us in 2008, and the Fed printed their way out of it by giving trillions and trillions of dollars to central banks around the world, to governments around the world, and to prime brokers and banks around the world. Now, that's no longer feasible because if they print more money, they're in a situation where it's going to create further inflation, and there is no more room for reduction on rates unless they want to further increase inflation. They're stuck between a rock and a hard place, ladies and gentlemen. That is why, sadly, a recession is inevitable here. Downward revisions concerning 2022 GDP prospects has been gaining traction. And look at job listings in June. Job listings in June are down almost 3%. There's a higher number of deleted job listings in red, a lower number of created job listings in green for one well, let's see here, less created job listings for 1, 2, 3, 4 months, 5 months in a row. 4-month reduction, and still at levels that are going to continue to decrease here. Let's put it quite simply. 94% of all states in the United States are seeing a reduction in jobs right now. These are job openings and the S&P 500 sub-index for human resources. This is in black, U.S. S&P 500 human resources sub-index and the U.S. job openings. As you can see, this has dropped from around 425 to 269 for U.S. S&P 500 human resources sub-index, when the lagging indicator here of U.S. job openings is going to follow. As you can see, it's always either slightly ahead or slightly behind. And at this point, well, I think it's slightly behind. We are reaching that 1,000 viewer level of resistance. Please drop a like, consider subscribing if you'd like to learn more, and share this on social media so we can get other people to view the realities of what's going on in our economy and our stock market, because it's an absolute sham. 45% of small business owners and employers have stopped hiring. 45%. And 4% plan additional layoffs. Everything from gyms to beauty salons, real estate, restaurants, and transport, you name it. Retail, auto repair shops, finance, dentist offices, plumbers and legal offices, even construction, of course. This is based on a poll of over 5,300 small business owners over the period of about 2 months in 2022 here. This is the 4-month change in initial jobless claims. This was the jobless claims during Hurricane Katrina in 2004. These were the jobless claims in 2008, 2009 at a high of around 150. The previous was, in the late 1970s and 80s. And now in 2020, well, this chart's just not big enough because during COVID it skyrocketed, and right now in 2022 it's right here, and it looks like it is increasing exponentially straight up, just like it did in 2020 and 1980, 1979. Housing is a business cycle. Plain and simple. The risks of a recession and higher unemployment are getting more clear every single day. Look at unemployment here in the United States in light blue compared to the survey-based regression that we were just talking about here in dark blue. This seems to lead by 5 months, and given an extreme number of job openings, it's very plausible that higher unemployment is to follow. This is S&P 500 earnings per share on a 12-month trailing basis in light blue, and then red, and then the macro-based earnings per share model in dark blue, which has continued downwards for the future of the model. The rest of this year and 2023 are looking extremely sad for the state of our future. Households are highly indebted, and that is a huge vulnerability. Walmart, as a matter of fact, is a big point of contention. They had earnings today, and they slashed their profit outlook for the second quarter of the second quarter and for the whole 2023 as well.
It's highlighting that could be read across the entire sector.
Absolutely. I think it's the inventory glut that we've seen that continues to persist. So we knew inventories were high in retail when they reported last quarter in May, but but that trend continues to be the case, and that's really the biggest miss here. It's that they haven't been able to clear the inventory as they had expected, so there's further markdown pressure in the quarter and probably through the rest of the summer, quite honestly. They have to clear a lot, so you could read across to Target and to other retailers that have been over-inventoried that they too could be facing similar issues. Though for Amazon, I think the issue is a little different. It's not an inventory issue, right? It's the capacity issue of overbuilding the warehouses and the added inflation costs and transportation, which if you read on what Walmart wrote, those are costs that they've actually managed through. So to some extent, it's a positive for Amazon in my view.
A positive for Amazon, not seeing that yet in the stock reaction. And if you look across the after hours reaction, again, big moves in Walmart, down 8.4% at the moment. Poonam, obviously this news was surprising to the market. You can see that clearly in the shares. I'm curious though, calibrate what we're...
The thing that's different about a Vrbo vacation home?
So basically, the sales for Walmart are expected to be greatly reduced. The increasing levels of food and fuel inflation, they said, are affecting how customers spend. And while we've made good progress clearing hardline categories, apparel in Walmart US is requiring more markdown dollars. This means that Walmart, in my own words, and Walmart is having to reduce their prices on currently inventoried goods because they've got an overstock of inventory, as we just heard from the young lady that was just discussing it on Bloomberg. Walmart continues to say, we're now anticipating more pressure on general merchandise in the back half of the year. However, we're encouraged by the start we're seeing on school supplies in Walmart US. They said adjusted earnings are forecast to slide between 8 and 9% for the second quarter and 11 to 13% for the year, a sharp decline from its May forecast of just a 1% pullback. Operating margins are increasing at 4.2% for the second quarter, as well as 3.9% for the year. There's a 33% increase in overall inventories last quarter. Guys, in one quarter, Walmart inventory increased by 33%. This is because the American consumer, as I've shown you here several times, does not have the available personal savings to buy things that are not essentials. Food inflation is in double digits and higher than it was at the end of the first quarter and higher than it was the quarter before that. We are not peaking, we have not peaked, and we will continue to increase the rate and exponentially of this inflation until equities markets completely collapse. Inflation's too high, the consumer is tapped out and has to limit their spending. Walmart and other retailers are way over inventoried, and now they have to liquidate inventories into a weaker economic environment. While this is good news for consumers that have a few bucks, because they're going to see some sharp decrease in prices, there's a lot of inventory to liquidate for major retailers. And this is going to drag the broader market lower. And there's also going to be employee liquidations. They're going to lay off employees. The only question is whether this will be seen as good news or bad news and will force the Fed into end its hiking cycle. I highly doubt it, though, because they are so far behind that the Fed is consistently acting much too late. And then they follow up by saying statements such as, we were unaware of the effects that were taking place in inflation, and they were beyond our control after everything was transitory. Putin is now turning the screws, according to Zero Hedge. Gazprom unexpectedly halts another Nord Stream turbine, cutting flows in half. European gas prices are soaring, guys. Absolutely soaring. Can you guys hear me in the think tank? I think so. All right, good. Check out the Nord Stream 1 flows here in blue and in red.
Светлана Витальевна Чупшева, председатель ВЭП РФ, Игорь Иванович.
Сейчас вот говорят, вернут эти машины.
Now, Canada says they will return the Nord Stream 1 Siemens gas turbines. At least one of them will be returned. But in what condition will they be returned? What will the technical parameters be after the planned repair has been completed? Maybe Dima, the Special Presidential Representative for Digital and Technological Development, Dmitry Peskov, correctly said they will go ahead and turn it all off at some point, and that's it, and Nord Stream 1 will stop. Because the turbines came from there, from Canada, and really is a matter of great importance. We need our own engineering schools.
Инженерные школы.
There you have it, ladies and gentlemen. Gas flows from Portavaya will drop to as much as 33 million cubic meters per day starting tomorrow, which means flows along the Nord Stream 1 pipeline will be cut in half from a capacity of 40% flow to a capacity of 20% flow. According to Bloomberg energy expert Javier Blas, with Nord Stream 1 flowing at just 20% capacity from July 27th, Germany will not have enough natural gas to make it through the whole winter, unless big demand reductions are implemented. Berlin will need to activate Stage 3 of its gas emergency program. It's my little one. She's playing in the other room, pounding on the door. She's got to get in, see? But they continue on to say that Germany's energy security remains at risk and prices remain volatile. In a knee-jerk response, the European TTF natural gas prices spiked 10% and likely to keep rising. That was just today alone, the 10% rise. As Putin just assured that all else equal, a recession in Germany is now inevitable. And yet, since commodity prices will continue to rise, the European Central Bank remains helpless. It can't cut rates without sending inflation even higher, but it can't keep hiking with Europe now in a recession. That's the same thing I told you about 10 minutes ago about the United States. And it's not because I said it, but or anybody, because it's common sense. It's common sense. Everybody can see it except the Fed, because they are purposely lagging the market and lagging the indicators. The euro, which jumped late last week on some naive optimism that a worst case could be avoided, has slumped. That's the dump in the difference between the euro and the US dollar. Right around, they're almost exactly the same now at this point. Steer here at 1.02 euro to USD. Check this out. Bulls don't feel bad. Perma bulls get burned. Goldman Sachs started the year with a prediction of 4% growth here for this year, 2022, and 4 rate hikes equaling 1%. That was way, way up here when all the bulls were still hanging on strong, pretending the market was going to stay at all-time highs forever. Now they're predicting 14 rate hikes. Got that right. From 4 to 14. We're looking at a 3.5% interest rate and a recession. Absolute monstrosity of what we've seen so far has just been a warm-up. It has been a warm-up for the things that we're about to see. The reduction in asset and equities from 4,800 and the all-time highs we were seeing to the current of 3,900 and change, and just shy of 4,000, on the S&P. Well, I highly doubt we see that 4,000, and if we do get there, it's not going to be for very long. United Kingdom inflation was expected to be at 8.8, but now is averaging much higher. They're looking at, let me find it. Excuse me, sorry. Lost this one. Oh, don't get me started on Coinbase, guys. Not yet. United Kingdom inflation was expected to be around 8.8 and 9.0, which it was previously. And now it's going to average 9.4 in the third quarter and expected to hit 10.2% in the fourth quarter. That's why these guys in the UK and in the United States, of course, as well, have absolute all-time lows of consumer confidence. We looked at 8.8, 9.0 in the UK in the last two quarters. Now, next quarter is expected to be at 9.4 and then 10.2%. And, well, we know that the Federal Reserve and the central banks have consistently been wrong and purposely lied to us. So what numbers are we actually going to see for next quarter and the fourth quarter? The economy was expected to grow for the United Kingdom previously 3.7% and is now expected to grow only 3.4% this year and 0.6% in 2023. The Bank of England is expected to lift the bank rate by 25 basis points to 1.5% interest rate on August 4th, according to about 29 economists. Some of them are also saying 50 basis points, which would be an even better, in my opinion, but nowhere near enough what is actually needed to curb inflation. Again, this is the purposeful destruction of the middle class. This, my friends, is a residential mortgage industry report for the spring of 2022 for the country of Canada. Okay, now this is very important because the mortgage-backed securities markets are interconnected between Canada, America, China, Ukraine, and everywhere in between. We've got to explore this data here. And you can see some very interesting things. For example, 53% of Canadians have adjustable rate mortgages in 2020, in the second half of 2021, compared to 34% in the first half of 2021. The reason that the majority of people get adjustable rate mortgages is because they can't afford the house on a fixed rate mortgage. Because the first half, usually the first 2 years or 5 years of an ARM loan, is a very, very low interest rate and then balloons very quickly after that point. Given the increase in spread between variable and fixed interest rates, the majority, 53% of all Canadians, shifted their preferences in interest rate terms, opting for variable interest rates in the second half of the year. Look at what was happening in 2008. We were here in 2008 before the actual market crash, and we are nearly at that level now. This is the increasing discount on variable rate mortgages. This is the discount on variable rates in gray and the share of mortgages with variable interest rates in yellow. As you can see here, the actual government of Canada is telling us directly, the acceleration in mortgage borrowing was due to increases in uninsured mortgages for both property purchases and refinancing in terms of both volume and value in dollars. Chartered banks recorded a rise of 43% in new mortgages originated for property purchases and an increase of 22% in refinances compared to 2020. As a result, banks added approximately $400 billion worth of residential mortgages to their balance sheets. Credit unions added $54 billion worth of new residential mortgage to their portfolios, and mortgage investment companies also registered an increase. Let me see if I can zoom in a little bit for you guys on this one. This is really, really bad news because when you have 53% of all the country with adjustable rate mortgages, Well, for example, when a company like Evergrande or Country Garden or any of these other Chinese developers go bankrupt, they drag the entire global mortgage-backed securities market with it. And then credit default swaps skyrocket, just like in 2008. Just what Michael Burry told us about, what the whole movie The Big Short was based around. That's happening and has continued to happen since then. It has not, there's been no changes that Dodd-Frank that have actually been implemented that have actually made a difference. They've just found ways to get around it, such as by shifting those assets overseas to their holding companies instead of maintaining them here in their banks in the United States. They still own the assets. It's just a subsection of the parent company. Shares of newly originated uninsured mortgages are slightly higher in the lower distribution loan-to-value ratios. Chartered banks. Subprime mortgages are up. Again. Mortgages in arrears, delinquent for 90 or more days, continued their downtrend across all lender types. Seems pretty flat. This was 2020 and then 2021. There are less mortgages in arrears because many people are coming out of their forbearances and are no longer qualifying for forbearances because the governments are no longer giving more. Period. Most alternative mortgage borrowers return to the conventional market or sell their property without being in default, although this trend has been decreasing in the last decade. They're telling us clearly that most borrowers that buy these adjustable rate mortgages have to get into a fixed interest rate, which is going to be obviously now much higher, and they might not be able to afford it due to their income to debt ratio, which is very important when getting a home loan. In addition, they also state that they might have to sell, or these people sell their property without being in default, meaning that people have to sell the property because they can no longer afford the adjustable rate balloon mortgage, or they cannot afford to qualify for the fixed interest rate mortgage to get them out of the balloon loan. This is the exact same thing that we saw in the market crash of 2008. Here you can see 64% switched to a conventional lender, 9% of people sold the property, and 28% switched or renewed their adjustable rate mortgage with an alternative lender. That is for the people that had an effective exit strategy. That does not include defaults and people that were forced out. This is the first quarter 2022. This is the most recent quarterly report available on bank trading and derivative activities from the Office of the Comptroller and the Currency. Four large banks hold 89% of the total banking industry notional amount of derivatives. Okay, derivatives, this toxicity is what has been causing the need for more and more bailouts and more margin collateral. The percentage of centrally cleared transaction derivatives quarter over quarter increased slightly to 43%. But what this basically is saying is that dark pools are the other 67% of this. So lit markets, if you know what that means, like trading in the actual, for example, the New York Stock Exchange or IEX, not run through a dark pool, is only 43.4% of all equities combined. But that still means that the other approximately 67% or 66.6% here of this is being traded on dark pools. This is the most recently available report released by the Office of the Comptroller of the Currency, Washington, D.C., June 2022. And what this tells us, quite simply, is a lot of things that most people never bother to look at. Check this out. Speaking of the OCC, these guys over here that are begging for money, the ones that in order to meet their payment obligations, they need to maintain access to cash from a variety of sources, which is why they are pledging cash collateral to the OCC and various agreements with banks and other counterparties, liquidity facilities, to provide the OCC with cash in exchange for collateral, such as U.S. government securities, just like the Federal Reserve RRP, reverse repurchase program, of which 100 counterparties took $2.127 trillion today in exchange for the overnight Treasury securities. Here we go. The OCC and other supervisors dedicate examiners of the largest banks to continuously evaluate the credit, market, operational reputation, and risk balance of banking and trading derivative activities. Here you can see that credit exposure from derivatives decreased compared with the last quarter, around 49 billion, as they're trying to dump off as much of this as possible. Derivative notional amounts, though, increased in the first quarter of 2022 by $22.9 trillion. Derivative contracts remained concentrated in interest rate products, which totaled $145.9 trillion, which is almost 73% of the total derivative notional amounts. The vast majority of these are rehypothecations and net settled trades between each other, traded in dark pools. Basically swaps in order to counteract the toxicity of the others. The year-over-year change in interest rate products is up 1,051% out of sheer desperation for liquidity by these banks. Holding company trading revenue. Trading performance provides a more complete picture of trading revenue in the banking system. As shown in Table 2, consolidated holding company trading revenue was $1.3 billion more than in the previous quarter. The quarter-over-quarter increase in trading revenue was primarily due to increases in revenue from Forex and commodity and other trading instruments. But year-over-year, holding company trading revenue still decreased by $12.1 billion. That's a 44.5% decrease in trading in holding company revenue. These banks are losing money hand over fist. They've continued to tell us that before the 2008 financial crisis, trading revenues at banks ranged from 60% to 80%, and that now that they've supposedly fixed it, it is now between 30 and 50%. But in the first quarter of 2022, banks generated 70% of consolidated holding company trading revenue. Wow, very, very violent over there. You hear that? Excuse me one second. The credit exposure is bilateral in most derivative transactions, such as swaps, which make up the bulk of bank derivative contracts. Each party to the contract may, and if the contract has a long enough tenor, probably will have a credit exposure to the other party at various times during the contract's life. With a funded traditional loan, the amount risk is the amount advanced to the borrower. The credit risk is unilateral. They both have credit risks, is what it means, as the bank faces the credit exposure of the borrower. These mortgage-backed securities that I just got done telling you in Canada, in the United States, South America, Africa, Europe, Russia, and China are all linked. Whether they're commercial, whether they're residential, doesn't matter. It doesn't matter. They are all linked, and the vast majority of this exposure is bilateral in these derivative transactions and swaps and contracts, and all these banks are facing credit exposure to the borrower. Now, I'm going to say something that's probably not going to make a whole lot of sense, but try to follow me if you can. I know a lot of you are very intelligent people, so you'll probably get this. The total of all contracts with a positive value, such as receivables, to the bank is the gross positive fair value and represents an initial measurement of credit exposure. The total of all contracts with a negative value, those are payables, to the bank is the gross negative fair value and represents a measurement of the exposure the bank poses to its counterparties. So one is the initial credit exposure to themselves, and the other is the exposure to the counterparties. That exposure has increased in commodities and other sorts of swaps, such as abusive swaps. equity total return swaps, and so on, callable yield swaps, yield notes, and all sorts of others, has increased 184.4%, as the equities swaps has decreased by 12.5%, and interest rate swaps also, the gross positive fair value percentages for interest rate has decreased, as well as equities, but the commodity percentages of gross positive fair values, which is the initial measurement of credit exposure, has increased 184%. These are very big increases in their exposures. Granted, it's still a slightly negative here. These numbers are in the billions, so that's 2,203 billions, which I think is around $22 trillion. Let's continue on if you guys want to see precious metals and dark pools, because it's extremely important. The volatility index is currently being highly suppressed due to the use of swaps between forex, such as the Japanese yen, the US dollar, and the Canadian dollar. These are all being traded with and against each other, and all sorts of swaps are being taken out by the Federal Reserve using the ESF fund. I think Economic Stability Fund, but it's somewhere around those lines. I can't remember the exact word for it. And what that means is that it allows the New York Fed to trade on behalf of the plunge protection team to create swaps and prop up the United States dollar. Propping up the DXY is causing other fiat to lose value compared to the dollar in order to prop up our financial markets. So basically, the Federal Reserve is throwing Canada and Europe under the bus. That being said, the total derivative notional amount by underlying risk exposure quarter over quarter has still gone up 6% total. It went up 6% in one quarter to $200,354 billion in the first quarter of 2022. That's up from $177,464 billion in the fourth quarter of 2021. That's a $22,891 billion increase of 12.9%. That's absolutely fucking insane. A 6% year over year change, 34% of which are in credit derivatives. Bilateral netting is the effects that we were just discussing regarding that. The actual effects of their ability to reduce their exposure, and that is actually being decreased as well. The effects of bilateral netting are not as helpful to the banks as they once were. In addition, centrally cleared derivative contracts, that means on lit exchanges, on lit markets, not in dark pools. Only 2.9 to 1.9% of all Forex trades are happening in lit markets. The other 98% are happening on dark pools. This is why the prices of silver, gold, and other precious metals, precious metals are right here. Forex, fiat and stuff like that. This is why they're so easily manipulatable by these central banks, because they can trade all sorts of swaps amongst each other in 97, 98% dark pools. That's not something that we can ever do. So they've got complete control over the value of different fiats. Equities, almost 75% of all stocks and equities are being traded on dark pools. Precious metals, anywhere between 98%, basically 92 to 98% of all precious metal trades, for example, like silver, gold, palladium, etc., are traded in dark pools. Only 2 to 6% are really traded on lit exchanges. This is the way of manipulating the actual price and cost of these metals. let's get down to the absolute disgusting numbers. So the notional amounts of derivative contracts by these banks, for example, the top 25 banks is 199,254,718,000,000. Now that's an absolute ridiculous number, because if you think in terms of seconds, I believe 1 million seconds is about 12 days. 1 billion seconds is about 32 years. 1 billion seconds is 32 years. That's the difference between 12 days is 1 million and 32 years is 1 billion. But 1 trillion, well, 1 trillion is not days or years. There's not 32 years. It's 31,000 some odd years. So 1 trillion seconds takes 31,000 years. Think of how vast the differences are in the numbers between a million, billion, and a trillion using that. 12 days, 32 days, 31,000 days. That's the difference. These guys have, just those top 25 banks have 199 trillion, 254 billion, $718 million worth of these total derivatives, but their total assets are only 15 trillion. So do you see the amount of over leveraging that's happening here? For example, JP Morgan, 3.5 trillion in assets with $60 trillion in total derivatives. This is the sum of total derivatives. Credit derivatives have been included as an over-the-counter category, although the call report does not differentiate by market. These are absolute ridiculous numbers and leverage that should not ever exist, ever. So the fact that it does is quite sickening. And when we saw these toxic derivatives in the swaps market and real estate market really cause issues in 2008 and then previously in 2000 with the tech bubble, those were just one and two slight problems that were going on, and still not slight, let's put it this way, but they're going to look very small in comparison to everything that we're currently seeing, especially with these amounts of derivatives. Wolfie, is there anything that you'd be able to, jump in here with and discuss with us, man? Because I'm absolutely disgusted at the amounts that we're seeing here. We saw in 2008, these guys only had around $70 trillion in total derivatives. And we're now seeing, if you add all of them up combined, we're seeing around $440 trillion just in banks and their holding companies, toxic derivatives and rehypothecations. It's a complete unsustainable when you see the top 4 commercial banks have only $8.1 trillion in assets, but $178.2 trillion in total derivatives. It shows you just how too big to fail these banks really are. And when you start to see crumbling of markets, equities markets, real estate, bonds, and cryptocurrencies, then you begin to see these too big to banks fail. And many of them, unfortunately, are going to end up having to cover short positions. Short positions in silver, gold, meme stocks, AMC, GameStop, BBIG, Sundial, you name it. A lot of these heavily shorted stocks that are owned by majority by retail investors are going to most likely see higher prices than they've ever seen before. The mother of all short squeezes will likely happen, not because it will cause a crash, but because a market crash as a byproduct will render a short squeeze in commodities markets, for example, like we saw in the short squeezes of nickel and other precious metals and commodities, and heavily shorted stocks in the past. Much like we saw in January of 2021, January 28th, where the buy button was pulled from AMC and GameStop by dozens of brokers and market makers, making the stocks go position close only out of sheer desperation. That's not exactly something that's going to be plausible when the entire market's collapsing and prime brokers and banks are absolutely desperately grasping at the collateral that they need to get back, those shares that they need to recall that they've lent out. And they're not going to care if the DTC is not margin calling them, if they want to collect the money back from the family offices and hedge funds of which they've borrowed billions and trillions of dollars, as proven here in all these numbers, in the varieties of bad bets and bilaterally netted current credit exposures, potential future exposures, total credit exposures from all contracts, risk-based capital. It's more than they'll ever have combined. And that's why we're now seeing bank runs in China and Russia and soon the United States. For those of you that are unaware, many countries in Europe and in Mexico, for example, have never, ever in history had a single bank failure. The United States of America has had more bank failures than any country in the world. If you're not concerned about where your money is invested, you fucking should be. You absolutely should be. Let me get this out of here. This thing's lagging pretty bad. Come on, work with me. I could listen to System of a Down any day. But yeah, you could easily pull this up for yourself. This is from the Canadian Mortgage and Housing Corporation. And you can Google them and you will be able to find these documents. And you can come up with these conclusions yourself. And these others are from the Office of the Comptroller of the Currency, OCC.gov. As well as the Federal Register is located at federalregister.gov. And you can find this release tomorrow, 7/26/2022, on the Federal Register from the Options Clearing Corporation, where they are absolutely desperately begging for money in order to meet payment obligations in the event of a clearing member default. The OCC would be obligated to make payments on time related to that member's clear transactions. And again, as we continue to see equities markets and stocks and bonds and crypto collapse, we're going to see the Federal Reserve act way too late, as they always do, and make the wrong moves. The New York Fed, the actual New York Fed, just did a study last week, and they came to the conclusion that there is a 10% chance of a soft landing. That being said, I wish you all peace and wealth. Look into your financial investments. Figure out what runs inverse to the market, what may or may not make you a lot of money, or at least prevent you from losing a lot of money. Because I'm not a financial advisor or a legal advisor of any sort, but I do recommend that you look into your own finances, and if you need to, hire somebody that has fiduciary responsibility to you to make you money, not to lose your money. If anybody else would like to jump in and say anything else, you're more than welcome to. But that's about it.
Mr. Marcel.
My man, Pantheon.
Marcel, how you doing, my friend?
I'm doing great. What's going on, brother?
How would you like some good news?
I would love some good news.
I would love to give you some good news.
All right.
We have just confirmed 30 minutes ago an interview to take place next week on your channel. Would you like me to go further, or do you want me to hold it there and keep the suspense for people?
Why don't you go ahead and tell everybody who we're going to interview next week?
So, Mr. Marcel, Mr. Boss Blunts, and I have been working together to secure an interview for next week. We've got a confirmation from the company. I got to go through dates with you, Marcel. We are going to be interviewing Diane Garrett, the CEO of Highcroft, on this channel next week leading up to the August 4th AMC earnings to talk about the NFTs, to talk about the exploration program, and any other connections with AMC going forward as we head into our Q2 earnings call. This is excellent news, sir.
Fantastic. Thank you very much, my man Pantheon. Make sure you guys check him out on YouTube, Pantheon AMC. We are going to be interviewing Diane Garrett next week. Thank you very much for taking the time to speak with her and to set this up, Pantheon. We truly appreciate you, my friend. You're an absolutely phenomenal member of this community. Diane Garrett, for those of you that are unaware, is the CEO and president of Highcroft HYMC. She is a very experienced and highly able team leader with a superb track record, even as stated by the one and only Silverback CEO Adam Aaron. So I'm very much looking forward to speaking with Miss Diane Garrett.
Mining. This weekend's surprise upset between St. Peter's University and Purdue was a historic win for the underdog. At Highcroft, some may have bet against us too, but we rebounded strong in March. I first want to welcome what seems like a world of new stakeholders and friends into the Highcroft family. And we're thrilled to have you join us on this journey of developing one of North America's leading gold and silver assets in one of the best mining jurisdictions, Nevada, USA. Now, many of you came to us through our first financing of March, where we did a $56 million private placement equity offering with renowned precious metals investor Eric Sprott and AMC Entertainment Holdings. We then did a $138 million follow-on at the market offering, and this combined $194 million allows Highcroft the runway to continue the exploration and development of this world-class asset. Now, many of you have wondered if my Twitter account is fake. Nope, it's just that I've been mining my own business, and I haven't been on social media until the events of March. But I'm over the moon excited about joining this online conversation, and I hope to be helpful in bringing to you modern day mining and the amazing men and women who dig deep for success. So stay tuned for future videos, and who knows, maybe one day our story will make a great movie.
Phenomenal news. I'm very much looking forward to speaking with Miss Diane Garrett next week here on this channel. Thank you again, Wolfie. If you guys want to catch that, make sure you're subscribed so you don't miss it. And don't forget to ring that bell. Obligatory stupid YouTube saying, not that I care, but people don't get notifications as it is. So if you'd like to, by all means, go ahead. Thanks everybody again for joining us on Think Tank tonight. I wish you peace and wealth. Have yourself a great evening. We'll catch you again tomorrow for yet another live stream. Thanks everybody.
Peace.
Fucking Trudeau. He's going to do the same thing that these assholes did over in Holland. You guys know it. Trudeau's going to steal farmers' land, shut down their ranches. It's going to be pretty sad. United States is right behind. Biden's going to issue an executive order and most likely do the exact same thing. They're going to cut down our food supply, increase the cost of food for us. It's all on purpose.
Boss, are you still live streaming?
Yes, sir.
Okay. Let me know when you're done.
I'm so goddamn rich.
I think it's time to blow this thing. Get everybody in the stuff together. Okay, 3, 2, 1, let's go.
Getting fucking rich. I want my fucking money.
So fucking rich.
Griffin, I want my fucking money.
You're gonna be so goddamn fucking rich. Holy shit, guys.
Holy shit, we're gonna be so fucking rich.
That came up because people kept asking me, what's the TLDR? What's the TLDR? This Reddit post is too long. This thread's too long. It's that we're gonna be so fucking rich. That's the TLDR. But sadly, everyone else is gonna be so fucking broke.
fucking money.
You're an original,
Hey,
aren't
yelling,
you?
cowboy. Give me the fucking money. Get the goddamn money printer out.
Great. The bounty letter.
We're gonna be so fucking rich. Get the goddamn money printer out.